Welcome everyone, my name is Michael Boutros, currency analyst with Daily FX. This is a course on beginner Fibonacci. It's a topic that's very near and dear to me. It's been often my weapon of choice with my trading throughout the years. I get a lot of questions on this during the webinars that we do, through email. You guys have expressed a lot of interest, so we will cover the basics of Fibonacci retracements, which is the most typically widely used Fibonacci tool. But I'm also going to take it a step further and we'll look into Fibonacci extensions, which is something that in my trading has been much more used, much more often implemented than the retracement. So we'll go over the difference. But before we get started, as always, this is our risk disclaimer. Obviously, you guys have all been here for 3 days or more at this point, so you know that currencies has a high level of risk. It's a very high leveraged product. And please make sure that before you try implementing any of these strategies that I'm sharing with you today, that it's in line with your own risk tolerance and goals for investment. So, moving right along. Let's take a quick look, real quick background. Obviously, you guys didn't come here to learn about who Fibonacci was, but just to give you an idea of where the concept comes from. It's actually named after an Italian mathematician, Leonardo of Pisa. His actual name wasn't Fibonacci. He was just known as Fibonacci. It was sort of his nickname. He introduced it back in 1202 in his book, Liber Abaci. And it's actually a series of sequence that dates all the way back to the 8th century in Indian culture. So it's goes back way before markets even existed, before technical analysis was even widely used. So the main thing that we want to understand of how the Fibonacci numbers are calculated, it's just a sequence. And every number in the sequence is actually derived from previous numbers. So if we take 0 plus 1, it's going to give you that 1. 1 plus 1 is 2. 2 plus 3 is 5. 3 plus 5 is 8, and so on. And if you guys are familiar with Pascal's triangle here, you'll see that if we actually take this pyramid and take the shallow diagonals, and add those sums up, we get that Fibonacci sequence again. It occurs everywhere. The main number that we want to always focus on is the 61.8% retracement. It's the key. It's known as the golden ratio in Fibonacci. We still use derivatives of those, so the 23.6, the 38.2, the 61.8, 76.4. These are all percentages that you'll hear in my reports and other people's reports, other analysts' reports on Daily FX quite often. Again, don't really look too much into this. Just know the basics of how the number is derived. But typically, we'll always mention, well, we're coming up on resistance at a 38.2 extension, or 38.2 retracement, or 61.8 retracement. So something to keep in mind. Now, this is not something that just comes in math. It actually is a recurrence that we see everywhere in nature, whether it's branches of a tree, arrangements of an acorn, actually galaxy and star formations. Tend to see these same types of ratios and formations happen over and over again. So again, it's not something that I made up or anyone that years back made up. It's something that happens everywhere in nature. So these patterns also show up in charting when we're doing technical analysis with any financial instrument, right? Not just in Forex, in equities as well. Commodities, you often see me post charts with gold or silver. Using Fibonacci retracements and extensions has been a great tool that I've used for years. So let's take a look at what the basics are. Before we even move into how to draw the extension, we'll just go over the basics real quick. Obviously, guys, we need to always identify what market we're in, right? So we want to find if it's an uptrend or a downtrend. Obviously, if it's an uptrend, we're going to see higher highs and lower highs, right? This is a classic uptrend. Everyone would agree to that, right? Quick question. Let me guess real quick. How many people here use Fibonacci? Okay. Just get an idea of where we're going here. All right, so we have this uptrend, series of higher highs and lower highs. Same thing with the downtrend. Very easy. Lower lows and lower highs. Easy enough, right? Pretty basic. This is where retracements come into play. When we have a flat or ranging market or a channel formation, a horizontal channel formations, this is where you want to really implement the Fibonacci retracements, which is the commonly used. You'll hear it all over the place. Fibonacci retracement on an extended move, or we're ranging between two Fibonacci retracements. This is really where we're going to implement that the most. Whereas extensions, which we'll jump into later, is more for trending markets. So, Fibonacci retracements works great with corrective pullbacks. What do I mean by corrective pullbacks? Well, there's a news data release that comes out. We see a big market spike to the upside. We're using retracements to see where we might find support on the way down. So this can happen on any level chart, guys. We can do this on a 5-minute chart, hourly chart, monthly chart, weekly chart, yearly chart. Actually, it tends to work pretty well with yearly charts. They're much more prominent levels. But we're identifying where we might find support on the way down. So if we have here a chart moving to the top side, again, I didn't want to put any figures or assign a currency to this, just to give you a measure of pure price action. First thing you would do is identify the move. So if this is a weekly chart or 10-minute chart, we see an extended move to the top side. We want to know where the market's going to retrace, where we'll find support on the way down. What we do is we take a Fibonacci retracement. It's a very simple tool. It's on MarketScope, it's on Strategy Trader, it's on pretty much all currency software, trading software, charting packages. And we're going to take the extension from the bottom to the top if we're on the top side. If the market's moving from the bottom, or we're moving on a bearish move, we're going to take it from the initial high to the initial low. And these are the extensions that we're going to target. So as the market plays out, this is where you should be looking to take your profit if you're looking to fade the move. If some of you were with me during the Bank of Japan intervention a couple weeks ago, when the market completely rocketed, right? A couple of hundred pips based on the Bank of Japan intervening to depreciate the value of the yen. Actually, CNBC came out and quoted that I had said that we should fade that move, or many people had said that. It wasn't just me, but we saw a nice pullback. And actually, the half-life of that intervention, which we all know is a horrible way of dealing with overvalued currencies, we saw a full retracement within a couple of days. So obviously, we won't get into the Bank of Japan messing around in the markets, but nonetheless, it's a great tool. So typically, if we see a pullback that fails to break the 38.2 extension, really fails to move through it, obviously we saw some price action dip below, but it really didn't close below it. That's an indication that that pullback is just a retracement, and we're going to see an extended move further. And that's actually what happened with this pair. It broke right to the top side. So at this point, you're probably asking, well, what am I going to do from here? That's where the Fibonacci retrace extensions come into play, and that's a tool that I use most often. So Fibonacci extensions take 3 reference points. And I'll show you a really easy way that you can gauge if you're drawing it properly. So we're using it more in trending markets, in breakouts. It works great if you have a formation, a wedge formation. You're trying to gauge where we're going to get a breakout to the top or bottom side. And we're going to take the last low to the most recent high, to the most recent low, and it's going to give you your top side extensions. If we were bearish on the market, we thought that the market's moving downwards, we're going to take our most recent high, last low, to the most recent high, and we're going to take our downside extensions. And again, I'll give you a look at what that looks like. But if we play these, we can actually see that the market tends to find nice support and resistance at these levels. Again, highlighting the 61.8. So once we broke above this, this is a nice indication that this move might be continuation. If we see a break of the 61.8. It tagged the top 100% extension, went right back down, rebounded again off this 618 extension, and we continue to play these ranges. If you guys have been following me, you know that I'm huge on scalping. It's my major form of trading. This tool is the tool that I implement the most to find my levels as far as where I'm looking to scalp little parts of an extended move. And you can see we could have played this over and over again. Now, obviously, it's very easy for me to show you a chart like this and tell you, hey, you know, just play these levels. But in combination with whatever indicators you're comfortable with, tends to work really well. So I'm really heavy with RSI. I know some of you love stochastic, some of you like MACD, but we're looking for convergence. So if we see that we're topping out at 100% extension, RSI, MACD, whatever you're using is overbought, that's a nice signal that we might find some strong resistance there and rebound to the bottom side. Likewise, we're looking for times when we break through these extensions, like right here, with a nice signal either on your, like I said, MACD or RSI. If we see a break here, and we see a steep or very steep slope on the angle of attack on your indicator, it's usually a nice signal that we're going to break right through that and test the next Fibonacci extension or retracement. So this is an actual chart. I think this was the dollar-yen. This was during the disaster, the unfortunate disaster that we saw back in March. I was working off this extension for a while. This was the initial move that we saw after the breakout to the top. So we're taking our fib extension from the last high to the last low to the last high. An easy way to know if you're drawing it correctly is that those 3 reference points should give you an arrow in the direction of your bias. Right? So if we're drawing it correctly, your 3 reference points should give you an arrow in the direction of your bias. So if your bias is to the downside, or we think it's a bear market, we're going to take the most recent highs and the most recent low. Whereas if it's the opposite, we're going to take the 2 lows and the most recent high. Does that make sense? Because it's really key with Fibonacci extensions. Okay, so we're bearish on this market. Let's say none of this price action has happened yet. We think that there's going to be a further extended move to the downside. So what we're going to do is we're going to take this last high right here. We're looking for prominent highs and prominent lows, guys. So we're taking this high right here, the most recent low, which is right around here, to the most recent high. So none of this price action has happened yet. We get our 3 reference points, and they're giving us a downside arrow. Do you see how it works? It's going to give you like an arrow, like a V format. It's pointing to the downside. This is what I like to call noise. And we really won't use this typically when we're taking the extension, because this is either a really heightened emotion or an extended breakout that happened due to some unforeseen event. So when I'm taking my extensions, I'll negate moves like this just because this was actually when we heard of the Japan earthquake and subsequent tsunami. So there was a lot of panic, and I wouldn't really take that as proper price action to take my retracements off of. So you want to be mindful. Obviously, we're looking for major highs and lows, but this move obviously didn't have too much conviction, right? It was really quick. The wick is very long. It kind of distorts the extension. So we'll tend to negate those. So we'll see a lot more examples. Don't worry, I got a lot of on here. So here's another. Again, I just want you to focus on price action here. So we're going to take our retracement from the most recent low to the most recent high. Say you're using RSI in the bottom here and you see clear divergence, right? We think that this is going to be a prominent high and the market will move lower. We're going to go ahead and take our Fibonacci retracement and wait to see if we break that 23.6. If we break this 23.6 extension, in my eyes, our target, first of all, will be this 38.2, and we'll keep going down right through the levels. It's really what the scalping reports are based on, if you guys were here yesterday for that. So if we do see it break, or if we see it hold, the main thing that we're waiting on the extension, on the retracement, to see if we find a breach of that topside high point. So if you're taking your Fibonacci retracement and the level that you have as your high or low gets breached, at that point, we're going to negate that and we're going to jump into a Fibonacci extension again. So if we take this move and we come all the way back down to here, it's a 100% retracement, right? If I move from here to here, and then I move back to here, I've retraced that move 100%. So that's all these levels are designating. So if we only come down to this level, we've only retraced 23% of this entire move. So we're waiting to see if these levels will hold or not. And when we're scalping, if you've been with me on the webinars, you'll often see me say, hey, I'm waiting to see if this 23.6, 61.8, whatever the extension is going to hold. And that's when I use my indicators in combination with that. So if we see indicators are giving us more steep downside moves and we see a break, our next target's going to be that subsequent next level down. So it'll be this 38.2 right here. Basically what we're doing is we want to see what degree of retracement. If I take it from the top to the bottom, right, this is going to be 0 here, and that's going to be 100, which doesn't really make sense because we're measuring what percentage of this move we want to retrace. So we're seeing this initial move to the top side. We want to wait to see what percentage of this initial move we're going to retrace. If we're moving to the downside, we take it from the top to the low. We want to see of what size of this move we're going to retrace to the top side. Right, it'll be the reverse. So on this specific one, the 23 actually held. It was a pretty ugly hold. I actually got faked out on this one and did take this short and got stopped out on the top side. But nonetheless, we did see a break of that initial top that we used for the extension. In comes another example. One thing I do want to stress with Fibonacci, guys, is that nothing supersedes basic support and resistance. Okay? So if we're looking we're playing a level between the 23.6 and the 61.8, well, if there's a major support line there in between, that's going to supersede all the levels. So the major thing that I'll do is I'll draw just my basic formation. This was a nice wedge formation that we saw. With these types of moves, if your reference points, I'll say this slow, if the reference points are actually tags of trend lines, they tend to work much better. So on this specific pair, we're using these 3 reference points, right? These tend to work really, really well, at least in my experience. Can't guarantee you it's going to work every time, but in my experience, I've seen that these work very well, giving us our downside targets, right? So we think that we're still going to continue to range, we're going to continue to consolidate into the apex of this wedge formation. And again, if you've been on the webinars, you'll know that I only use candlesticks, I use solid colors. And the reason I do that is because I don't like red and blue and things of that nature or whatever to shift my bias. I'm looking at pure price action. I don't care if it's an up candle or if it's a down candle. I just want to know where price action has been. So let's see how this played out, actually. So we reached that top of the wedge formation, and actually, we rebounded right off it. We broke right through the 23.6. We broke right through the 38.2. And I was trying to get this chart, actually, so it stopped right here, to prove one point. If we see a break of the convergence, so if there's an overlap of an extension with a trend line, either if it's a trend line resistance or a trend line support, those moves are usually much more substantial. Okay, so if this break actually held out, we would expect to see a steep run to the downside. Often. Again, nothing's 100%. So, with the same respect, if there's a convergence of trendline support and a Fibonacci extension, if that holds, it's usually a really nice rebound to the top side. So we'll see that that break was actually a really substantial break. And this actually turned out to be a very nice play, and it went all the way to the 100% Fibonacci extension, right? Because we're using the 3 reference points, the 3 circles that you see in green there. Our bias was to the downside. We were looking for a break of this wedge formation on this specific pair to move lower. So if you're a scalper, these would be your targets. I'd be taking profit here, waiting for a break, taking profit here, waiting for a break, taking profit here, waiting for a break, and so on. But you can use this in combination with whatever indicators you guys are comfortable with. One thing that's crucial, guys, and that no one here in this entire expo can really teach you is that you have to have a bias on any pair that you trade. And what I mean by bias is just a basic expectation of whether that pair will move higher or lower. There's a lot of different ways you can do that. There are some guys who will look at a monthly chart or a daily chart and kind of gauge where price action's been going. For me, I'm more of a mixture of both technicals and fundamentals, so I look more on the fundamental outlook. In comparison to the major economies of the world, how is that economy performing, right? We can do this a lot of different ways. We can look at GDP, we can look at unemployment, we can look at trade balance. We can look at all these things just to get a gauge of which of these currencies we think is going to be more in demand by investors. Does that make sense? Okay. So let's look at more examples. I knew there was going to be a lot of questions, so I tried to include as many examples as possible. So before we move forward, just a couple of major things that I want everyone to be mindful of is that Fibonacci extensions, although they've been my tool of choice, it is just for reference. So give yourself room. You know how many times I'll put a scalp report with a couple of Fibonacci extensions, and then it'll literally miss the extension by 1 or 2 pips. And boy, are you guys vocal when that happens. It's just for reference, right? Nothing's 100%. You're never going to get a full tag every single time. Although I must say, in my experience, I've seen that they've worked pretty well. But sometimes we'll see a couple pips past the extension. Sometimes we'll miss it by a couple pips. But the majority of the point is that we're using this as a reference point for where we're looking for markets to find congestion. Make sense? Again, we're going to highlight that it's very significant when these extensions or retracements are converging with basic trendline support and resistance. And like I said, I stress this in all my presentations, that nothing supersedes support and resistance. Nothing. I don't care if you have a million indicators telling you to buy or a million indicators telling you to sell. If there's strong support on a daily or a weekly or a farther out chart, we're either going to see some congestion at that price level or we're going to soar right through it. It's very, very rare that you'll see it dip below and just trend lower very slower, right? It's going to either be a break or it's going to be a rebound. Again, nothing's 100%. But that's what tends to happen more often than not. So that's what we just mentioned. If we see a break of those convergence, we'll see a substantial move or a substantial rebound. And we'll look at a couple of different cases where this happened. So, should have probably omitted this extension, but let's just say for argument's sake this extension is not here. We're just looking at price action, continuing to consolidate within this wedge formation, right? Once we saw that peak at 90.77 at the top side there, that's when I drew the extension. So we took it from this high to the most major low. We were still consolidating here. Once I saw a break of this trend line resistance, we topped out here. RSI was showing extremely overbought signals. And so that's where I took my extension from. If this price action had not happened, we would take the extension from here to here to here. We have to keep adjusting it. And one of the major problems or major mistakes that I see traders make is that they'll draw their extension, will either make new highs or new lows, and they'll just keep playing those levels. But we need to keep adjusting it, right? And that's going to be determined by what time frame you're working on. So if we work on a daily chart and we're drawing a daily extension or daily retracement, that might hold for a month or so. But if we're working on a half-hour chart or a 30-minute chart, you're probably going to have to adjust that within the next couple of days. So keep in mind. So once we did draw this extension here, you can see that we saw convergence of the 38.2 and this trend line. Well, former resistance now should work as support theoretically, right? Well, again, convergence. We saw both of them overlapping. That break was pretty substantial to the downside. And that was actually a nice move there on this pair. So turns out that we actually saw this trend line support here hold. Actually, this goes back further a couple of months on this pair, but we continue to play these ranges. Once we saw a break here, and I wasn't convinced that this was an actual break of this formation. That's why I waited for a break of this 76.4 extension, right? Because the move didn't show too much conviction. We moved out of this formation, and if this was a strong trend line support, we should see a little bit more substantial of a move, like we did here when we broke to the top side. So I wasn't really convinced that this was a break. We see false breaks happen all the time, right? Everyone know what a false break is? We test trend line resistance or support. We peak a little bit above it. You start to think, hey, this might go, but it's kind of running out of steam, and it pulls right back in. So I was expecting that this might pull right back into this wedge formation until it reaches that apex. Well, what actually happened on this pair, which I don't have for here, but we actually saw a break and moved right back to that 100% extension and continued lower. Okay, so moving right along here. So breakouts usually see more substantial moves. We looked at this one right here. Let's look at an example of how this played out. And if you guys were with me for a couple other presentations, this is one of those cherry-picked examples that I did a lot of animation on. I just really am proud of, so I'm going to keep showing it. So we saw a trend line. We saw convergence here. Price action was making higher highs. RSI was making lower highs. We took an extension on this run right here using these 3 reference points. Once we applied the extension, this was the euro-dollar, and this is a 4-hour chart, guys. We saw market price action jump right between these levels. So first we tested the 23.6, RSI still trending to the downside. We broke the 23.6, we moved lower and tagged the 38.2. As we're tagging the 38.2, we see that RSI is bottoming out. So it just so happens that when we see this ricocheting off the 30 oversold level, well, the 38.2 held, we saw a nice rebound off the 32, and we tested the 23.6. It's amazing how clean it works sometimes. Well, once we tag that 23.6, we look at RSI. Well, there's a nice trend line here in RSI. It was working as former support. We broke former resistance. Once we broke to the top side again, former support. Broke to the bottom side. So technically, this should see a rebound here, right? We want to see this move lower. Well, that's exactly what happened. We saw a rebound at this level. The 23.6 held, and we went all the way down and tagged the 61.8, the key level. One thing to keep in mind is that the 50% is actually not a Fibonacci extension or retracement in its truest sense, but it's included just as a gauge of, okay, this is half the move. We saw the move pair half its gains. So we want to really keep an eye on the 23.6, the 38.2, the 61.8. I like to use the 76.4. There are some people who use 78.6, but I prefer the 76.4. If you use Strategy Trader, how many people here use Strategy Trader? Okay, how many people use Market Scope? Okay. Fibonacci extensions are not on Market Scope. But the good news is, after all of your push from all of your emails, which I do appreciate, we'll have that on there starting next week. I believe there's going to be a beta version, so a lot of you will be able to jump on with the extensions. So again, cherry-picked example worked like a charm, right? And we actually continued to play between these levels repeatedly. Once we saw a break of this trendline support in RSI, coincided beautifully with a break of this 38.2, take a long. Now, it's not always going to work, and that's why I extended it to this far, because we actually didn't get a tag of this 23.6. This is about that point where I start getting really bad emails that are mad at me. We just got shy of it. RSI actually broke this again to the downside, and we continued to play lower. Right? And we can continue to see this play over and over again. And notice, guys, I haven't redrawn this extension because we haven't made any fresh new highs or lows, right? We're still continuing to play within this range. I'm still going to hold this extension as is. Now, if I see a breach on top of here or a break below our reference points, at that point, we want to redraw our extension or retracement according to what price action is doing. Make sense? Okay. And again, we actually topped out, overbought. We saw a break of this RSI trendline support. Coincided pretty well with this break of this 23.6. Automatically went for the 38.2 extension. And again, you know, we could keep going with this chart and show you months and months worth of data where this has played out pretty well. This is a euro-dollar chart. So if you guys have been following me, I've actually been waiting for this euro-dollar drop for about 3 weeks now. And it just so happens that while we were on the plane here from New York, all hell broke loose and the euro just tanked a couple hundred points. So I don't have the updated chart, but this is where we're sitting at right now. We saw a break of this trend line support. We saw a break of the 61.8, and we're sitting right here actually at 136.50. Now you'll see that 136.50 actually lines up with a former peak that we made earlier in the year, right here. But I'll show you something even cooler in a second on a real chart with a weekly chart that'll give you an exact, clear as day why we found support there. But to play along with this example right here, we're still condensing, right? We're still consolidating within this wedge formation. We see a downside break. Well, RSI has shown clear support at this level, which is right around 39 or 40 level. And we saw a rebound off that 50% extension to the top side. Okay? All right, guys, that's all I got for you today. I will be at the booth if you have any questions. I'll be here a little bit if you also have some interim questions you want to ask. But enjoy the rest of the expo, guys. Thank you.